December 17, 2025. Lower Manhattan, New York City. The opening bell echoes across the marble halls of the New York Stock Exchange. A metallic clang, sharp and ceremonial, slices through the low hum of voices and screens. Monitors flicker green. Numbers surge upward in synchronized rhythm. Traders sip burnt coffee. Algorithms awaken. Outside, winter air presses cold against the glass towers of Wall Street. But inside, optimism is warm, almost euphoric. The S&P 500 is hovering near 6,900. The Dow is flirting with 48,000. The Nasdaq is printing new all-time highs. Financial television anchors smile with rehearsed confidence. Analysts speak of resilience, soft landings, and a new era. Central bankers hint at rate cuts. Commentators celebrate what they call the triumph of modern monetary policy. From the outside, it looks like stability. From the surface, it feels like control. But history teaches us something uncomfortable. The most dangerous moments in financial systems arrive not during panic, but during confidence. This is the paradox at the heart of every great crash. In 1929, the newspapers celebrated prosperity. In 2000, technology promised a future without limits. In 2008, housing prices never fell nationally. And each time, the warning signs were not hidden. They were ignored. Today, the same pattern is repeating, only this time. The scale is larger, the leverage is deeper, and the margin for error is thinner than ever before. This story is not about a single event. It is not about one bad decision or one reckless institution. It is about convergence. 14 independent warning systems, each with decades of history, are now flashing red at the same time. Not one, not two, all of them. These are the same indicators that quietly signaled danger before every major collapse of the last century. And together, they are forming something far more precise than fear. They are forming a countdown. To understand why the window narrows between mid-2026 and late-2027, we must step back, far beyond today's headlines, and trace the architecture of the modern financial system. The story begins in March 2009, at the depths of the global financial crisis. Markets were broken. Banks were insolvent. Trust had evaporated. In response, central banks did something unprecedented in scale and duration. They flooded the system with liquidity. Interest rates were pushed to zero, then below zero. Trillions of dollars were created, not through factories or productivity, but through balance sheets. At first, it worked. Asset prices stabilized. Confidence returned. Growth resumed. What was supposed to be an emergency measure slowly became permanent policy. Years passed. Then a decade. Low interest rates didn't just encourage investment. They rewired behavior. Corporations learned that debt was cheap. Governments learned deficits had no immediate consequence. Investors learned that risk would be rewarded, and volatility would be suppressed. A silent assumption took hold. The system would always be saved. But systems built on intervention carry a hidden cost. They accumulate imbalances quietly. Debt doesn't disappear. Risk doesn't vanish. It simply moves to places harder to see. Corporate balance sheets swelled. Speculation normalized. Valuations detached from historical reality. Markets stopped pricing risk and started pricing policy. And then came 2020, a global shutdown unlike anything in modern history. Governments injected trillions more. Savings spiked. Asset prices soared. The gap between the financial economy and the real economy widened into something unprecedented. For a moment, it looked like another miracle. But miracles in finance are usually delays, not solutions. By 2022, inflation returned. Central banks were forced to reverse course aggressively. Rates surged from near zero to levels unseen in decades. And suddenly, the very policies that inflated the system began to stress it. What had once been fuel became pressure. Now, as 2025 closes, the contradictions are everywhere. Markets are priced for perfection, yet growth is slowing. Consumers are leveraged, yet savings are depleted. Banks are exposed, yet confidence appears intact. Central banks are trapped between inflation and recession. This is not chaos. This is late cycle order, the calm precision that arrives just before structural failure. The architects of this system are not villains. They are policymakers, economists, bankers, and institutions responding to incentives built over decades. Each decision made sense in isolation. Each intervention felt necessary at the time. But history doesn't judge intentions. It judges outcomes. And the outcome of prolonged stimulus, suppressed volatility, and historic leverage is always the same: instability disguised as strength. Somewhere between mid-2026 and late-2027, a threshold will be crossed. Not because someone chooses it, not because of a single headline, but because systems governed by math, debt, and human psychology eventually reach limits. When they do, selling accelerates, liquidity vanishes, confidence flips. The same voices that celebrated resilience begin searching for explanations. And once again, the public will ask, how did no one see this coming? The answer, as always, is uncomfortable. They did. This documentary is not a prediction. It is not financial advice. And it is not an attempt to inspire fear. It is an examination of patterns. Patterns that repeat across centuries. Patterns that ignore optimism. Patterns that emerge only when incentives, leverage, and time converge. Over the next chapters, we will examine the mechanisms quietly tightening this countdown: valuation extremes, debt cycles, banking fragility, policy traps, and human behavior under stress. Not to sensationalize collapse, but to understand it. Because the most dangerous myth in finance is not that crashes happen. It is the belief that this time is different. The clock has already started. And the question is no longer if the system will reset. Only when. December 17, distortion, 2025. Every market crash Lower begins Manhattan with a New York City balance. The opening bell echoes from across the marble halls by late 2025 of the New York Stock Exchange. U.S. equities are not merely expensive and ceremonial. They are historically unprecedented. Through the low total market capitalization has expanded monitors far beyond the productive capacity of the underlying synchronized rhythm. This imbalance is measured most clearly by the Buffett Indicator, which compares the winter air presses cold against the national towers of Wall Street. Historically, inside that ratio hovers near 100%, almost euphoric. In 1929, the S&P 500 danger levels is hovering near 6,900. It peaked near 148% in 2007, just before the Nasdaq is printing 105 all-time highs. Now, financial television anchors 30% with rehearsed confidence. This is not optimism. Analysts speak of resilience, mathematical landings, and the Schiller-Cape ratio tells the same story hint from another angle. Stocks are priced celebrate what they call the triumph fair value of modern monetary policy. Either a permanent from the outside, in productivity, it looks like stability, or an eventual from the surface. It feels like control, irrational but longer than expected, but they cannot stay disconnected forever. The most dangerous valuations don't collapse in financial systems because investors panic, not during collapse, because future returns disappear. This is when the expected returns at the heart of every great crash. Confidence becomes in fragile. 1929, any shock, the newspapers celebrated prosperity can trigger in 2000. Technology promised the future, margins for error vanished. In 2008, leverage, the housing prices never overvaluation alone and does not cause crashes. The warning signs were not hidden. Margin debt has surged toward $800 billion. The same pattern placing it near 3% of GDP. A level the scale is larger. The leverage is deeper, and the margin for error is thinner than 2007. This story transforms declines into avalanches. It is not about one bad decision. When prices rise, reckless institution amplifies gains. It is about convergence. When prices fall, 14 independent warning margin calls, each with investors are forced to sell, are now flashing red at the same time. Selling pushes prices lower. Lower prices trigger more margin calls. Indicators. This is not psychology. Danger. It is before every major collapse. By the time panic appears on television, and together, the damage is already something by margin algorithms executing liquidation orders at machine speed. To understand why the window narrows
judgment
between
from
markets
mid-2026
at precisely
and
the wrong
2027,
moment,
corporate
we must
debt,
step back
the refinancing
far
wall.
beyond today's
From
headlines
2020
and
to
trace the
2021,
architecture of the modern
corporations
financial
borrowed
system
aggressively
The story
at
begins in March
historically low
2009.
interest rates.
At the depths
Debt
of
was
a
cheap.
global financial crisis,
Refinancing
felt
markets
optional.
were broken.
Risk
Banks
seemed
were
distant.
insolvent.
By
Trust
2025,
had evaporated.
total corporate
In
debt
response,
has reached
central
$14
banks
trillion,
did something
nearly
unprecedented
50%
in
of
scale
GDP
and duration.
The problem
They
is
flooded
not
the
the
system
size of the debt
with liquidity.
It's the timing.
Interest rates were
Between
pushed to zero,
2026 and
then below
2027,
zero.
trillions of
in
dollars
low-rate
were
corporate
created,
debt mature.
not through factories
What once carried
or
a 2 to
productivity,
3%
but through
interest
balance
rate,
sheets,
must now be
At first,
refinanced
it
at
worked.
5 to 6%.
Asset prices stabilized.
That difference
Confidence
is lethal to
returned.
margins. Growth
A company
resumed.
paying $60
What
million
was supposed to be
annually
an emergency
in interest
measure
suddenly pays
slowly became
$180
permanent
million.
policy.
That
Years passed,
$120 million,
then a decade.
does not
Low
disappear.
interest rates
is
didn't just
removed
encourage
directly
investment.
from earnings.
They rewired
dividends,
behavior.
capital spending,
Corporations
and employment.
learned that
Stock
debt was
prices
cheap.
are claims
Governments
on future
learned
earnings.
deficits
When
had
earnings
no
shrink
immediate
structurally,
consequence.
prices
Investors
must
learned
adjust.
that risk would be rewarded and volatility would be suppressed. A silent assumption took hold. The system would always be saved. But systems built on intervention carry a hidden cost. They accumulate imbalances quietly. Debt doesn't disappear. Risk doesn't vanish. It simply moves to places harder to see. Corporate balance sheets swelled. Speculation normalized. Valuations detached from historical reality. Markets stopped pricing risk and started pricing policy. And then came 2020. A global shutdown unlike anything in modern history. Governments injected trillions more. Savings spiked. Asset prices soared. The gap between the financial economy and the real economy widened into something unprecedented. For a moment, it looked like another miracle. But miracles in finance are usually delays, not solutions. By 2022, inflation returned. Central banks were forced to reverse course aggressively. Rates surged from near zero to levels unseen in decades. And suddenly, the very policies that inflated the system began to stress it. What had once been fuel became pressure. Now, as 2025 closes, the contradictions are everywhere. Markets are priced for perfection, yet growth is slowing. Consumers are leveraged, yet savings are depleted. Banks are exposed, yet confidence appears intact. Central banks are trapped between inflation and recession. This is not chaos. No optimism can override arithmetic. Commercial real estate, the silent collapse. If equities represent optimism, commercial real estate represents denial. Office vacancy rates now sit between 20 to 30%, driven by remote work, corporate downsizing, and structural shifts in how cities function. Property values have fallen 40 to 60% from their 2021 peaks. But the debt remains. Consider a typical office tower. Valued at $200 million in 2021 now, worth $100 million carrying a $150 million mortgage. This property is deeply underwater. Between now and 2027, over $1.5 trillion in commercial real estate loans mature. Banks must decide whether to refinance assets that no longer support their debt. Many won't. Defaults rise quietly. Losses accumulate silently. And balance sheets weaken before the public notices. Regional banks, the weak link. In early 2023, the collapse of Silicon Valley Bank, Signature Bank, and First Republic offered a warning. Emergency liquidity masked the problem, but did not solve it. Regional banks still hold over $1.3 trillion in commercial real estate exposure. These institutions lack the scale, diversification, and capital buffers of major banks. When losses are recognized, capital evaporates quickly. Banking crises rarely begin with insolvency. They begin with confidence loss. Once depositors question safety, withdrawals accelerate. Liquidity vanishes. And solvent banks can fail simply because trust collapses faster than balance sheets can adjust. By 2026, this risk is no longer theoretical. The consumer exhausted and leveraged. The American consumer has carried the economy through past downturns. This time, the consumer enters late-cycle conditions already strained. Total consumer debt exceeds $18 trillion. Credit cards, $1.2 trillion at 22% interest auto loans, $1.60 trillion student loans, $1.77 trillion. Delinquencies are rising across every category. More importantly, savings have collapsed. The personal savings rate has fallen from 16% during COVID to near 4%, well below the historical average of 9%. Households no longer have buffers. When layoffs rise, even modestly spending contracts immediately. Defaults rise. Credit tightens. Feedback loops accelerate. Consumer weakness doesn't cause recessions. It amplifies them. Employment, the lagging signal. Unemployment is rising slowly, just enough to be dismissed. From 3.4% in early 2023 to 4.5% by late 2025. But according to the SOM rule, when unemployment rises 0.5 percentage points from its low, a recession has already begun. This rule has predicted every recession since 1970, without false positives. By this measure, the economy is not approaching contraction. It is already inside one. Markets, however, continue to price growth. This divergence never resolves gently. Manufacturing and leading indicators. Manufacturing has remained in contraction territory for most of the period since early 2023. Historically, manufacturing downturns precede broader recessions by 6 to 12 months. At the same time, the leading economic index has declined for over 20 consecutive months, its longest decline since the global financial crisis. These indicators exist to warn early. When they are ignored, the eventual correction is harsher. The Federal Reserve no escape route. The Federal Reserve faces an impossible dilemma. Cut rates too quickly, and inflation resurges. Hold rates elevated, and debt-driven sectors collapse. There is no policy path that avoids pain. The only remaining control is timing. By signaling confidence and gradual easing, the Fed buys time, but time increases imbalances. The longer pressure builds, the more violent the release. Central banks can delay cycles. They cannot repeal them. Geopolitical volatility, the spark. Markets priced for perfection are vulnerable to any disruption. U.S. China tensions over Taiwan, prolonged war in Ukraine, Middle Eastern instability. None of these need to escalate into catastrophe. They merely need to interact with leverage. In overextended systems, triggers are interchangeable. What matters is not the spark, but the fuel already laid. The final convergence. By mid-2026, all timelines align. Debt maturities peak, refinancing costs surge, bank balance sheets strain, consumers pull back, employment weakens, valuations leave no margin. This is not coincidence. It is structure. Bull markets don't die of old age. They collapse under accumulated pressure. Between mid-2026 and late 2027, that pressure reaches its limit. The countdown completes not with a bang, but with a sequence. Liquidity dries. Confidence breaks. Selling accelerates. Narratives reverse. And only then does panic arrive. Not as a cause, but as a consequence. The system does not fail because people are foolish. It fails because incentives reward risk, because memory fades, and because time compounds fragility quietly. By the time the headlines change, the clock has already run out. The countdown is not dramatic. It is inevitable. Every financial era ends the same way, not with universal agreement, but with disbelief. Long before the crash becomes visible, the evidence is already complete. The indicators are in place. The imbalances are measurable. The incentives are known. And yet, the system continues forward, not because it is healthy, but because momentum is powerful and memory is short. History does not repeat because humans fail to learn. It repeats because systems reward the same behavior until they can no longer sustain it. What we have traced is not a prediction of a date, nor a claim of certainty. It is a structural alignment, a narrowing window, where debt, valuation, policy, and psychology converge. Markets priced for perfection. Consumers stretch thin. Banks exposed to assets that no longer justify their debt. Corporations facing refinancing costs
that erase margins overnight. And central banks, constrained by the very tools that once stabilized the system. Each pressure alone is survivable. Together, they form a closed system under stress. When pressure builds inside a sealed container, release is not optional. It is inevitable. The period between mid-2026 and late-2027 matters not because of superstition or fear, but because financial systems operate on timelines. Debt matures. Rates reset. Savings deplete. Employment lags. These processes cannot be postponed indefinitely. They move quietly in the background, indifferent to optimism or denial. By the time markets acknowledge reality, the mechanism is already engaged. Crashes do not begin with panic. They begin with liquidity hesitation, then repricing, then forced selling. Panic is simply the moment the public notices. Throughout this documentary, one truth emerges repeatedly. The most dangerous myth in finance is not that crashes occur. It is the belief that intelligence, technology, or policy has finally eliminated them. Every generation believes it is different. Every cycle proves otherwise. The architects of this era did not act maliciously. They responded rationally to incentives, crises, and short-term pressures. But rational decisions made in isolation can produce irrational outcomes at scale. That is how systems fail not through villainy, but through accumulation. The lesson is not fear. It is awareness. Those who study history are not spared volatility, but they are rarely surprised by it. They understand that markets do not move in straight lines, that leverage magnifies error, and that stability itself can be deceptive. The purpose of examining this countdown is not to forecast collapse, but to recognize patterns before they become headlines. Because when confidence finally breaks, explanations arrive too late to matter. Somewhere in the future, long after the charts have reset and narratives have shifted, the same questions will surface again. How could this happen? Why didn't anyone warn us? And the answer will sound familiar. They did. Quietly, calmly, long before the noise. The clock does not accelerate. It does not hesitate. It simply moves forward one decision, one refinance, one assumption at a time. The countdown is not dramatic. It is structural. And once it completes, the market will not ask for permission to reset. It never has.